3 years ago, I met a guy at a wedding. Let's call him Michael. Michael managed his own portfolio. He had just a bunch of spreadsheets and a lot of stock screeners. He spent a lot of time on this, probably closer to 500 hours over a 2 to 3 year period. And I, on the other hand, was doing none of that. I had 3 funds and an automatic bank transfer. That's it. At some point that night, we decided to compare our returns. I know, probably like a pissing contest. But what we found was his returns had actually slightly underperformed mine. Now, he lost a lot of sleep over this, but I, on the other hand, slept like a baby. Now, this story is not about me being lucky or better in any kind of way. It's actually about what we've been taught to believe investing requires versus what it actually takes. Also, none of this actually happened. I just thought I would set the scene to keep your attention. So hopefully that worked. Here's something else nobody tells you. The confusion around investing is their own purpose. Financial media and outlets need drama every single day. No, right? That's surprising. And platforms reward anxiety, and advisors who charge fees have legitimate reason to make things just seem a lot more complicated than what they really are, obviously for their own benefit. So instead of learning how to think clearly, a lot of people just end up with just unnecessary endless options, conflicting advice, and a fear that they're always just one decision away just from completely getting it wrong. So by the end of this video, I'll do my best to ensure that that feeling goes away. We're going to walk through a simple investing strategy, 4 principles that has quietly built more wealth for ordinary people than anything else out there. Before we get into the strategy, I want to be really clear on the goal. The goal of investing is not to try to be impressive at a dinner party, beat the market, or just have the best story. It's instead to steadily turn today's income into tomorrow's freedom. That's it. And once you learn to accept that, the strategy almost just explains itself. You don't need complex strategies. You just need clarity and time. So now let's get into the 4 principles. Principle number 1, own the market. Most people think that investing means picking winners, but here's a number that should permanently change how you think about all of that, all of those things. Over any 15-year period, roughly 86% of actively managed funds underperform a simple index fund. Not 10%, not 40%, I'm talking 86%. These are professionals and full teams with decades of experience. And most of them still lose to a fund that just owns everything. So that's what a broad index fund does. So instead of trying to guess which companies are actually going to end up being successful or win, you own hundreds or thousands of them all at once. I'm talking across multiple industries and across multiple countries. So when the global economy grows, you end up growing with it. And by doing this, you're not just betting on a specific horse, you're betting on the race itself. And this ultimately equates to fewer decisions, less regret, and just far less emotional whiplash. Principle number 2, automate so you don't end up sabotaging yourself. The biggest threat to your investing is not a market crash. It's actually you at 11 o'clock reading a headline and making a decision that you're going to end up regretting in the morning. We, as humans are wired at a biological level to overreact to short-term danger. Now, this instinct kept our, ancestors alive for a very long time. But today in investing, it's quietly destroying a lot of wealth. And automation removes the opportunity to be your own worst enemy. Because when your contributions transfer automatically, the same amount, the same day, every month, you stop treating every market move as a signal that's about your life. Principle number 3, risk should match time and just not your emotions or your mood. This is one that a lot of people just get completely backwards. They look at their portfolio when the markets are up and they feel brave and smart. And then they look at their portfolio when the markets are down and they feel terrified. Now, neither of these feelings is a useful signal. Here's the only question that actually matters. When do you actually need this money? If you need this money in about 3 years, you should try to keep it stable. Volatility is going to be your enemy. But if you need this money in 15 to 20 years or even 10 years, any kind of short-term swings are nearly just inevitable. They're going to happen, and they're also pretty irrelevant. Time is going to be your ally here. There have been times when the markets have dropped 20, 30, or 40% and then recovered and even went up higher than they were before. And every single time in modern history, that recovery just eventually ended up coming back. The people who get hurt the most aren't the ones who stayed in and invested. They are the ones that decided to panic and sell at the bottom. So when you align risk with your timeline and not your emotions or your mood, investing stops feeling very personal and it starts feeling very mechanical. And this is exactly what you want. Principle number 4, consistency beats intensity. This must be probably the least exciting truth in personal finance, but it's also the most important. The market doesn't reward intensity. It rewards endurance. The person who ends up investing through job changes, market crashes, any kind of chaos that's happening in your life, and even just throughout those boring, stable years and never stops, they will almost always outperform the person who tries very hard, but just inconsistently. Look, boring is the whole point. I'm talking real financial confidence does not feel exciting, at all. It feels very calm and unhurried and extremely boring. If your investing strategy requires your constant attention and having to check it daily and react to just every headline that's happening, it's asking too much of you and just your energy. And it's designed for someone else's benefit, not yours. A good strategy fades into the background of your life while quietly just doing its job. It's just let me do my thing. It doesn't care about the news cycle. It doesn't need you to be brave or disciplined or anything else for that matter. It just needs some time. So here's what we covered. Own the market. Don't try to outsmart it. Index funds puts roughly, 85, 86% of professional managers to shame. That's what the data says. Also, automate your contributions and just remove yourself as an obstacle. And then match risk to your timeline and not your mood. Also, not the headlines or not what's trending. And then the last one is probably the most important one. Stay consistent. Boring beats brilliant and sporadic. The hardest part of this strategy isn't understanding it. It's just accepting the fact that boring for years, if not for decades, is the whole point. You don't need to hurry try to get rich. For what? And you don't need to react to every headline. You just need to start and keep going. Thanks for watching.